For over a century, American economics has relied on an unwritten rule. The president runs the country, but the Federal Reserve runs the money. The two do not mix. The logic is straightforward. If politicians control the money supply, they might cut interest rates right before an election to create a short-term boom, regardless of the long-term economic damage. An independent Fed is designed to look only at objective data. Right now, the executive branch is actively tearing down that boundary, attempting to seize direct control over the levers of the economy. This turf war is playing out across two main fronts: a coordinated effort to force domestic interest rates down, and a battle to push international tariffs up. This institutional collision will dictate exactly how much you pay for a house, a car, and your groceries. The cost of living for every American is currently caught in the crossfire. The administration argues that inflation is already practically beaten, pointing to alternative data suggesting it's hovering around 1%. Based on that math, they believe interest rates should be dropping rapidly to match. But the independent Federal Reserve disagrees. In their most recent committee meeting, they voted 10-2 to hold rates exactly where they are, citing persistent inflation risks. This animated diagram shows how the administration is bypassing the Fed entirely. They've ordered Fannie Mae and Freddie Mac to execute a massive $200 billion mortgage bond buy. This capital injection specifically targets what's called a mortgage spread, the difference between the baseline government borrowing rate and the actual rate offered to homebuyers. By flooding the market with this bond capital, the administration can artificially compress that spread. Even with the Fed holding the baseline rate firm, this backdoor maneuver has successfully driven consumer mortgage rates down. While bypassing the Fed's policy, the administration is also attacking its leadership. The Department of Justice recently launched an investigation into Fed Chairman Jerome Powell regarding a $4 billion building renovation, with political allies suggesting incompetence or theft. The immediate goal of delegitimizing Powell is to clear the runway for his replacement. The administration has explicitly named Kevin Warsh as their pick for the next Fed chairman, an ally who would align the central bank's actions with the president's agenda. The executive branch is executing a calculated pincer movement. They are actively circumventing the Fed's monetary authority in the housing market, while systematically trying to decapitate the agency's leadership. The second battleground is trade policy. The administration heavily relies on international tariffs as their primary geopolitical tool, taxing foreign imports to create leverage. However, independent researchers at the New York Fed and analysts at Goldman Sachs recently published data that directly challenges the administration's claims about who actually foots the bill for these tariffs. This distribution chart shows the core finding of those reports. It breaks down the cost, revealing that tariffs act as a regressive tax. Exactly 90% of the financial burden flows directly to American consumers and companies in the form of higher prices, while only 10% is absorbed by foreign importers. That 90% metric directly contradicts the administration's central political claim that foreign countries are paying these taxes. Instead, the data indicates the policy is largely functioning as a direct tax on domestic wallets. The administration's response to this data was immediate retaliation. Top economic advisor Kevin Hassett publicly called the paper an embarrassment and demanded that the Fed researchers who authored the report be disciplined or fired. When objective economic data contradicts the political narrative, the administration's response is to target the researchers. Rather than adapting the policy to fit the facts, the strategy is to purge the scientists supplying the facts. Hanging over this entire economic offensive is the United States Supreme Court. The court is currently weighing a definitive legal question. Under the Constitution, does the president even possess the unilateral authority to levy these massive tariffs, or is that power strictly reserved for Congress? If the court strips this power away, the administration's trade agenda collapses. The government could be forced to pay back hundreds of billions of dollars in collected tariffs to the very importers they tried to penalize. But while the Supreme Court might place a hard legal check on tariffs, the siege against the Federal Reserve's interest rate policies and data operations remains entirely unchecked. The administration is systematically erasing the boundary between politics and monetary policy to consolidate economic power. If the Federal Reserve's independence is broken, the cost of any future political miscalculation won't be paid in Washington. It will be paid entirely by the American consumer at the checkout line.